Greetings. I, Dr. Alka Singh from Sri Ram Sukh Memorial University, Barabanki, welcome you all to my lecture on new financial instruments. The Indian financial system has undergone a significant transformation in the 1990s. The deregularization of lending rate, free pricing of equity issues, entry of private sector, institutional investors, including foreign institutional investors, opening up of banking sector to the private investors, allowing Indian company to directly tap the foreign capital market, and so on, the major reform which have changed the scenario of Indian financial system. The newfound freedom has increased competition in the Indian corporate sector. The capital market is an important source of meeting the growing long-term financial requirement of corporate, both in private and public sector. Hence, to cater to the requirement of both issuer and investor, it has become essential for issuer to innovation, or we can say innovate, and design new financial instrument. Financial re-engineering has been at the back of these innovations, which have become a revolution in the business world. When we say that new financial instrument, that means traditional instruments were there. There were reason why we are going for the new financial instruments. There are four major reasons. First, every product needs constant re-engineering. It has to be according to the customer's need. The interest rate had declined, and this trend forced the corporate world to think of new financial instruments. Investor also refers varying maturity periods. Companies prefer the capital market as a source of finance, so companies offer attractive terms even on debt securities in order to raise funds. Fourth, very important, that is, investors have shielded from the equity market in the last few years due to various capital market scams. Today we are going to discuss five major instruments. One is floating rate bond, zero interest bond, perpetual bond, deep discount bond, and securitized paper. First, we will start with the floating rate bond, also known as floating rate note, are a type of bond characterized by floating rate of interest. It is a concept which has been introduced primarily to take care of the falling market, or to provide a cushion in time of the falling interest rate in the economy. It helps the issuer to hedge the loss arising due to interest rate fluctuation. In India, State Bank of India was the first to introduce bonds with floating rate for retail investors. The SBI floating rate bonds were linked to the bank term deposit rate, which served as an anchor rate. The NSE MIBOR, Mumbai Interbank Offer Rate, is used nowadays as the anchor rate for floating rate bonds. To make this bond attractive to investor, the interest rate always has a fixed mark-up price over and above the anchor rate. Floating rate bond ensures that neither borrower nor lender suffer due to volatile interest rate. If the interest rate rises, the lender benefits as he earns higher interest, and if the interest rate falls, it is advantageous to the borrower as he can raise fund at the low cost. Since these bonds are having semi-variable rate of interest, they are also called floaters. They are complete opposite of fixed rate bonds. These type of bonds are normally issued by government organizations, institutional investors, mutual funds, etc. to tenure between 2 to 5 years. Now we are going to talk about the perpetual bonds. A perpetual bond, also known as console bonds or PREP, is a fixed income security with no maturity date. This type of bond is often considered a type of equity rather than debt. One major drawback of this type of bond is that they are not redeemable. However, the major benefit of them is that they pay the steady in steam steady they provide you interest rate continuously, but they are never redeemed. Therefore, it may be treated as equity, not as debt. Issuer pay coupons on perpetual bond forever, and they do not have to redeem the principal. Perpetual bond cash flow are therefore these are perpetuity. Perpetual bonds exist within a small niche of the bond market. This is mainly due to the fact that there are very few entities that are safe enough for investor to invest in the bond where the principal will never be repaid. Since perpetual bonds payments are similar to stock dividend payment, as they both offer some sort of return for an indefinite period of time, it is logical that they would be priced the same way. Now we'll talk about the zero coupon bonds. Zero coupon bond is a debt security that is sold at a discount and does not pay any interest payment to the bondholder. In other words, it's a bond that sells for less than its face value and does not make coupon payment or periodic interest payment during its life. Its maturity, it can then be redeemed as its face value, allowing the bondholder to make a profit. In case of zero coupon bonds, the maturity and durations are both are same. Companies and government use bond as a way of finance expansion and other long-term projects. The interest rate and terms of the bonds are set when the bond is initially drafted up. By the time of bond actually hit the public, interest rates have usually changed. That is why most bonds are issued at either a premium or a discount. Since the stated interest rate of the bond can't be changed, at this point, the sale price of the bond is changed. A bond issued at the premium sells for more than the stated value. Now we'll talk about the deep discount bond. A deep discount bond is a bond that sells at the price which is 20% or more below the face value of the bond and carries a low rate of interest during the term of the bond. Deep discount bonds allow investors to lock in a better rate of return for a long-term period of time, since these bonds are not likely to be called. Investor also enjoys the leverage that comes with such investment. However, investor must be prepared since these bonds are typically higher risk. A bond may also be issued at a significant discount if the coupon rate on the bond is significantly lower than going interest rate in the market, since the price of a bond is inversely related to the interest rate. An increase in interest rate will mean that bond rate of existing bond is not on par with newer bond issued at the higher interest rate. Deep discount bonds are typically long-term with maturity of 5 years of longer period and are issued with call provision. Investors are attracted to these discounted bonds because of their high interest and minimal change of being called before maturity. Issues, Issuer seeks the least cost method of raising capital through debt. Now we'll talk about the securitization. Securitization is a process where an issuer designs a marketable financial instrument by merging or pooling various financial assets into one group. The issuer then sells these groups of repackaged assets to investor. Securitization offers opportunity for investor and freed up capital for originators. both or of which promotes liquidity in the marketplace. However, securitization most often occur with loans and other assets that generates receivable such as different type of consumers or commercial debts. It can involve the pooling of contractual debts such as auto loans and credit card debt obligations. In securitization, the company holding the asset known as originator gather the data on the asset it would like to remove from the associate balance sheet. Now, in today's lecture, we have covered five major new financial instruments. Hope I have make you understood the topic well. Thank you.